Hello everyone, I'm Twinkle Jain and today we are diving into a topic that's not just about making money but about making a difference. Ethical and sustainable investing through mutual funds, especially focusing on ESG funds. As we become more conscious of our impact on the planet and society, the way we invest is also evolving. By the end of this video, you'll understand what ESG funds are, why they are gaining popularity, and how you can incorporate them into your investment strategy. First things first, what exactly are ESG funds? ESG stands for Environmental, Social and Governance. These funds invest in companies that meet certain criteria in these three areas. Let's break it down. Environmental factors include how a company manages its impact on the planet, such as reducing carbon emissions, managing waste, and conserving resources. Social factors focus on how a company treats its employees, customers, and communities, including issues like labor rights, diversity, and community engagement. Governance refers to how a company is run. Think about board diversity, executive compensation, and shareholder rights. Essentially, ESG funds are about investing in companies that are not just profitable but also responsible. Now, why should you consider ESG funds? There's a common misconception that ethical investing means sacrificing returns. However, this is not necessarily true. In fact, companies that prioritize ESG factors may perform better in the long run because they may be more resilient to a number of risks. For example, a company that invests in sustainable practices might avoid costly regulatory fines or reputation damage. Similarly, companies with strong governance are less likely to experience scandals or mismanagement, which can harm their stock prices. By investing in ESG funds, you're not just aligning your investments with your values, you're also potentially enhancing your returns. Let's look at some numbers. A study by Morningstar found that a majority of ESG funds outperformed their non-ESG counterparts over a 10-year period. This trend is reflected in India as well, where ESG funds have shown competitive returns compared to traditional funds. For instance, during market downturns, ESG funds may show greater resilience because they invest in companies that are better managed and more forward-thinking. This is particularly appealing to Gen Z and millennial investors who are not only looking for profits but also want to make a positive impact on the world. You might be wondering how to get started with ESG investing. The first step is to identify ESG mutual funds that align with your values. In India, several mutual fund houses offer ESG funds, each with its own criteria for selecting stocks. For example, some funds might prioritize environmental factors while others might focus more on social issues. It's important to review the fund's investment strategy and see if it aligns with what you care about. If you're passionate about combating climate change, you might choose a fund that invests in renewable energy companies. On the other hand, if social justice is your priority, you might look for a fund that focuses on companies with strong labor practices and diversity initiatives. Another crucial aspect to consider is the transparency of ESG funds. Unlike traditional funds, ESG funds require a higher level of scrutiny because the criteria for selecting investments are not always standardized. It's essential to choose funds that are transparent about their ESG criteria and regularly report on their impact. Many fund houses provide ESG scores for their investments, which can help you assess how well a fund is performing on environmental, social, and governance factors. This transparency not only helps you make informed decisions but also ensures that the companies you're invested in are genuinely committed to their ESG goals. Now, let's talk about the potential impact of regulatory changes on ESG investing. As the ESG movement gains momentum, regulators in India and globally are introducing guidelines to ensure that ESG funds maintain high standards. For instance, SEBI has mandated that mutual funds must disclose their ESG risk factors, providing greater transparency for investors. This is a positive development as it ensures that ESG funds are held accountable for their claims and that investors are protected from greenwashing, a practice where companies falsely claim to be environmentally friendly. But what about the challenges? One of the main challenges of ESG investing is the lack of standardized metrics. Since different funds use different criteria for evaluating ESG factors, it can be difficult to compare them. This is where doing your research becomes crucial. Look for funds that not only have strong ESG ratings but also have a track record of delivering consistent returns. Remember, ethical investing is not just about doing good, it's also about making smart financial decisions. Before we wrap up, let's quickly touch on the tax implication of ESG funds. In India, ESG funds are treated like any other equity mutual funds for tax purposes. This means that long-term capital gains, that is gains on investments held for more than 1 year, are taxed at 12.5% on gains exceeding 1.25 lakhs. Short-term capital gains are taxed at 20%. It's essential to factor in these tax implications when planning your investments, especially if you're considering ESG funds as a long-term strategy. To conclude, ESG investing is more than just a trend. It's a way to align your financial goals with your values. Whether you're passionate about the environment, social justice, or good governance, there's an ESG fund out there that can help you make a positive impact while growing your wealth. If you found this video helpful, stay tuned to our platform for more insights on making informed and impactful investment decisions. I'm Twinkle Jain, and I look forward to seeing you in our next video, where we'll continue exploring how you can achieve your financial goals with confidence and responsibility.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.